Alright, so good morning, good afternoon, and welcome to another training session for Danuvier Crypto Systems. My name is Daniel Uvietesewi. I'm the Chief Programming Officer at Danuvier Crypto Systems. So in this video, we're not really going to discuss much because in my previous video, I made all of us to understand that we've given you the basics on what you need to know about trading. We've talked about the different types of trades or different types of trading. We have spot trading, futures trading. We've talked about so many other things. But from henceforth, we are going to be doing more of charts and technical analysis and how we can read the bot signals to get a very good entry that's going to make us some money. So in this video, we are just going to talk about one thing, and then the rest of the video we are going to be looking at basically chart analysis, which means we are going to be going into the live charts. We are going to be looking at our moves to the upside, moves to the downside, looking at support and resistance. Okay, so let's dive right into the video. So the only topic we're going to talk about for today is going to be the top factors that can affect or ruin a winning trade. I will take it again. Top factors that can affect or ruin a winning trade. As you can see on my screen. So if we go right into this manual, it says number one, emotional trading. Now this is something that affects a lot of traders out there. Fear, greed, revenge. These are feelings that we all feel at some point in trading. You are going to have these feelings. Fear, you exit too early because you are afraid of losing profits. This is very normal because as you are starting up as a trader, you are not really used to the emotions of seeing negative balance on your account. You're not used to it. But trading is a game that even if you are seeing negative balance, there is no real guarantee that negative is going to stay negative for a long time. A negative balance can stay for 1 hour and then change to positive, and then for the whole of that day it can remain on positive. So this is something that traders need to learn to manage. Fear. You have your stop loss in place, you have your take profit in place, and your stop loss has already told the system that this is how much I'm willing to lose or risk from my money if the trade doesn't work out. So that alone should, it should get rid of that thing called fear. It should eliminate fear. I think that's the better word. So your stop loss should help you eliminate your fear, because you are already rest assured that you are not going to lose all the money in your account. It's just going to be a significant portion of it in your account. So fear is one of the emotions that makes a winning trade to be ruined. How will I put it? The trade that you are currently holding on to has the capacity to keep going on for the next 2 days, but since you are being moved by the negative balance you are seeing, that's the reason why you begin to you start to end your profits too early, or rather take your profits too early, and then you miss out on the greater move that's coming in the future. So you have to be strong as a trader and just trust your analysis, trust your plan, trust your process, and I can guarantee you, if you can do this, you are going to be having more of winning trades than losing trades. So the next one is greed. You hold too long. This is another one. A lot of people call me and they ask me, sorry sir, I got into a trade. The trade is working out, but they don't know where to exit. They think that holding it for more than 2 days, 3 days is going to give them more profits. No. What if the timeline for that trade is just 1 day? What if the timeline for that trade is just maybe 6 hours or 7 or 8 hours? So if you hold it beyond 6, 7, 8 hours or even a day, then the chances are sellers who also want to enter and make money as well, they're going to come in and they're going to ruin your trade. So it's always very, very important that greed should be managed properly as a trader. It's always very, very important that you manage your greed, because greed, like I've said in earlier videos, that greed is a killer. So if you are a greedy person, trading is not going to work for you, because you're going to make some very stupid emotional decisions, and it's going to end up you blowing your account or losing your money. So basically, that is what it is. So you hold on too long, hoping for more gains, and market reverses against you, like I've said. So greed is not something that you want to hold on to. Is let go of your greed and let the market give you what it can give you at that point in time. So basically, that is what it is. So the next one is revenge trading. Revenge trading is very common. Oh, you lost money now. Your ego is telling you, no, how can I lose that money? I must make the money back. No, trading is not like that. Don't allow your emotions to make you get into this revenge state. If you enter a revenge state, that's when you're going to even lose more money. And at the right of said, after a loss, you jump into another trade without a valid setup. So you can see that. So that's exactly what revenge trading does to a trader and does to your account balance. You will begin to make illogical decisions, or rather you will begin to make emotional decisions, and emotional decisions actually hurt your account in the long run. But as a trader, you are meant to trade with logic, not emotions. You lost this trade, fine. It was a small amount of money. You can easily recover it back on your next trade. Logic tells you, just stay out, wait for the next setup, and trust your process, trust your plan, and you will eventually make that money back. That's just what it is. But when you decide to revenge trading, you're actually going to break your rule and you're going to break your plan. And when you break your rules, break your plan, it's going to, in long run, affect your account balance. So the second point now is late entry or exit. Now, this one is also a very big one as well. So what does it say? It says entering too late after a strong move. Now, let's just say XRP, there was an impulsive move, or you saw the 3 white soldiers candlestick pattern forming, and it has formed completely, and that was the confirmation that, okay, yes, I need to enter this trade. But you hesitate. You begin to hesitate, and you find out that the trade keeps going and going and going, and you're wondering, I should have entered since. Just enter and trust your plan. Basically, that's just what he's trying to say. Just enter and trust your plan. Don't hesitate, don't doubt. Your stop loss is in place, your take profit is in place. Pull the trigger and let the market do its job. Now, entering too late after a strong move reduces your profit margin and increases your risk. Exactly. Because you are meant to, let's just say, for example, now the price is going up. You are meant to buy at a low price and then sell at a high price. But if you end up buying at a high price, what is the guarantee that you are going to sell at a higher price than the price you initially bought at? That's what I'm saying. So the bot already finds a very good place where buyers are beginning to enter to create that trend. And that area, if the trend is going up, that area is a support zone. And support zone are a combination of lower prices. So these are the areas where you want to enter if you want to join the move to the upside. But if you hesitate and you begin to wait and think about it for too long, before you know, the trade has left you, and when the trade leaves you, you don't try to chase trades, because it can be very disastrous on your account. So you don't chase. Okay, what if, for example, now you were supposed to have entered XMR, or let's just say XRP, at $2.50, and XRP jumps up to $3. You're like, oh wow, XRP 50-cent gain. Wow, I can enter now. And then when you enter now, it comes back to 250. Maybe that coming back to 250 is just a minor retracement. Then you begin to panic and say, oh, but this thing was moved before now. You get. Then you begin to panic and you start making all these emotional decisions. And before you know, you close out on your trade, you lose money, and then eventually XRP continues to go up in your direction. These are the things that we talk about every time. Trust the process. Once the signal has been given to you by the bot, enter. You have your stop loss, you have your take profit, everything. Just enter. Allow the trade play out. In fact, there is a strategy I normally use, and it has worked for me. When I enter a trade, I don't bother looking at my trades. I don't do it, because when you look at your trades, it makes you emotional. If it's showing a negative balance, it can make you begin to reason some very stupid thoughts. So once I enter my trade, I don't even bother looking at it. I just close my app and I go and focus on something else. And then when I come back, whatever I see, I take it like that. That's just how I do it. So entering too late, it can be disastrous. That's why we always advise that if you have missed the move, please wait for the next signal, because there will always be a next signal. This is a market that is being traded globally by banks, by corporate institutions, by the big government, the big time players, and even retail investors like you and I. So there will always be a setup, there will always be a signal from the bot. So I think that explains that very well. Now, exiting too early means you cut your winners short. So you can see that. Now, let's just say you have a very good setup now. You enter it very well, you follow your plan, you enter it very well, and the trade begins to move in your favor. And you have the information that this trade might last maybe 5 or 6 hours. And you are not too confident that no, I don't think it is going to last up to 5. It has happened to me several times when I was still a beginning trader. It has happened. So much money I ought to have made, but because I was not confident in my setup and in my plan, I decided to take all those peanuts that the market was giving me. For example, now, if I was expecting a $70 returns on a trade, and I'm not confident that the price will get to where it is to get me my $70 profit, I can say no, I'll exit at 35, exit at 40. No, but it would have been better if you had exited at 60 or 50 than 35 or 40, because you allowed the trade to play out very well. You were confident in your trade, you were confident in your plan, you were confident in your strategy. So you were confident enough to hold it for as long as possible until you actually got a reasonable profit from that trade. So that's why exiting too early is also very, very bad, because it also has an emotional effect, or rather a psychological effect on you. You begin to doubt yourself. You begin to, am I sure this trading thing is meant for me? You know, you start asking yourself all these stupid questions. So that's why we tell traders, when you are learning, trading is a skill. You learn the skill, develop it over time, trust your process, trust your plan. These are things that we see day in, day out, every day, day in, day out. The market goes up, the market comes down. There are 3 ways that the market moves. It's either the market is going up, the market is coming down, or the market is going sideways. So those are the major things, the major movements that the market can do. Either the market is going up, the market is coming down, or the market is going sideways. So I think that's explanatory. You can read the manual at your free time. So follow your bot signals promptly. Don't second guess them. Like I've said, the signals are being calculated. There are variables that we as traders don't see, but the bot can see. So it has calculated them and it has given you a signal. So just trust the signals, trust your process, trust your plan. So let's go to ignoring stop loss or take profit levels. Yeah, this is another very big one. So now they said moving your stop loss further away to give price more room often leads to deeper losses. Yes. Why would you want to move your stop loss? That's just very stupid in my opinion, because you were in a trade, your margin was $10, and your acceptable risk on that trade, which is your stop loss, was supposed to be like $1.20. Why would you go and move your stop loss and you accumulate more risk, and then at the end of the day you now end up losing $3 or even $4? No. If the trade is not working out, let it take you out at 120, because you know that on your next trade you can easily make that money back. That's just it. It's very self-explanatory. Please do not move your stop loss. It will eventually lead to more losses. Do not move your stop loss. So moving your stop loss further away to give price more room often leads to deeper losses, like I've said. So not setting take profit target means you might miss the optimal exit when momentum shows, or rather when momentum slows down. So when you don't set a stop loss, when you don't set a take profit, you're actually breaking your plan, because the take profit level might be the level where the market is going to get to, or the price is going to get to, before it begins to reverse and change direction. So that's why it is very important to set a take profit level so that when price gets there, the system takes you out and profits your account, or rather credits your account. So it's very straightforward. So your stop loss is your insurance. Exactly. Never trade without it. It's your insurance policy. You are using a $100 account, you are using a $1,000 account. The only thing that can protect that account from you losing it in one day is your stop loss. Because manipulation is something that we can never predict when it's going to happen. We can never predict when manipulation is going to happen. So the best thing you can do is to insure your money in your account and ensure that even though you take a loss, it's not going to be a big loss that's going to get you into problems. So I think that one is self-explanatory. So oversized position or leverage. Now, using too much leverage can magnify both profit and losses. Yes, that is why there is a formula to set your leverage. Maybe later on in the day, I'm going to post that manual how you can set your leverage so that you don't actually over leverage your account or put too much stress on your account. So, but later on during the day, I will talk about leverage. Now, using too much leverage can magnify both profits and losses. Even a small reversal can wipe out your gains or liquidate your position. Yes, because if you are using a $50 account now and you are leveraging 30x and you are running a $20 trade, which means your margin $20 and you are using 30x, that's just ridiculous. Because if price goes against you like 0.5% or even 1%, which means you're going to be losing like close to $10 from that money. That's not good enough. When you should have used a 15x, which is even reasonable, or a 13x or even a 10x leverage. Because if the price is going to go against you with a 10x leverage with a $20 account, you're only going to lose like maybe $2 or $3. So you can see, that's why leverage is very important. Learning how to use it. But don't worry, I'll be posting the manual so you can read and have a better understanding. So even a small reversal can wipe out your gains and liquidate your position. Okay, so keep risk per trade below 2 to 5%. So you can see that. So the overall risk on your account balance should be 2 to 5%. It is only professionals who know what they are doing that can risk up to 10% of their account balance. But since you are a newbie trader, I will advise that you risk 2 to 5% of your account balance. Please, please, and please. So I think that is self-explanatory. You can read it afterwards. So the next one, we have low volatility or choppy market. Now, when the market consolidates, signals can be weak or inconsistent. Of course, low volatility means the amount of people trading are not that much, so the price is not going to be swinging like it's supposed to. The banks are not yet trading, the corporate institutions are not yet trading, So let's just say the amount of money in the market at that point in time is like maybe $100 million. That's too poor. Meanwhile, on a very good day, on a very good trading day, the amount of money in the market should be in billions of dollars. Yeah, that is when the price is going to start moving and getting a sense of direction. So these are some of the things that will actually ruin a very good trade. So you might get stopped out by noise instead of a real reversal. Like I said, what is noise? Noise is simply how will I put it? Ups and downs of the market. Thank you. I think that's the best way I can explain it. The ups and downs, frequent ups and downs. That's what is called noise. A normal trending market goes up for a long time and it begins to retrace for a short period, and then it continues going on. That is a trending market. But a sideways or a consolidation market or choppy market is one that just goes up, down, no sense of direction. It's just going up, down, and it's moving in a sideways pattern. What that tells you is that the amount of people in the market are not really placing trades, so the liquidity in the market at that point in time is very low. So, and it's not enough. The orders are not strong enough for you to start a trend. That's what is called low volatility. So, avoid trading low volatile sessions or before major news events. That's what, like I've said, these are the times where you need to avoid trading, because you will get stopped out easily. That was why this bot was created, so that it can let us know that, okay, the market is becoming volatile. You need to start placing your trades now. Okay, a lot of people are placing trade, the price is moving. So basically that's what the bot does. The bot just alerts us, okay, I think there's movement on this currency pair. Let's see what we can